Well, hi everyone, and welcome to Buffett and Beyond Research Stock of the Week, and this is September 13th, 2025, and we're going over ARISTA Networks, and folks, this stock is up 1,087% in the past 5 years. It is firing on all 8 cylinders. And remember, if you want to live on this beach like Jimmy Buffett once did and have lunch with him like we all did at one time, then you've got to learn how to invest even better than Warren Buffett does now. And let's look at ARISTA and what it does. Well, it's a leading supplier of cloud networking solutions for large-scale internet companies, cloud service providers, and data centers for enterprises. There's that word data centers that we keep hearing about all the time. And these solutions include its extensible operating system, EOS, a set of network applications, and its 1040, 100 gigabyte Ethernet switches. I guess they're important, folks. These products are sold through both a direct sales force and channel partners, and I guess it's working if it's up over 1,000% in the past 5 years. And yeah, it has a strategic partnership with VMware to enhance the adoption of network virtualization, has approximately 4,400 employees, and that's almost 1,000 more than when we went over this stock last time. And we're only talking about 8 or 9 months ago, folks. So this company is expanding. And let's take a quick look. Blue line is the average stock in our database, so they're all pretty good stocks, large cap, mostly large cap stocks, and they have a clean surplus return on equity of 13.5%. ARISTA, 2.5, almost 3 times that of 33.7%. And the way you want to look at this is, would you rather put your money in a bank that's making you 13.5% or put it in a bank that's making you 33.7%? Yeah, that's how you look at the clean surplus return on equity. Now, net income growth, and the average stock is about 13, or average stock in our database about 13%, and ARISTA 39.8%. Folks, we're looking at 3 times the amount of the average stock. Revenue, it's bringing in 27% a year on average. These are 5-year averages, while the average stock in our database 7.1. We're looking at 4 times the amount of the average stock. So yeah, it's firing on all 8 cylinders. And let's look at some more numbers. We want to look a little closer at the clean surplus ROE, and we can see that I like to look at the 3, the 5, and the 10-year averages, and boy, this stock is pretty steady and above our threshold of 20% to get into our growth portfolio. Not every stock has to have a 20% clean surplus ROE or above, but the portfolio has to average 20% or above. Retention rate, everything that it's making, it's putting it back into itself in order to grow. And how do we know it's using that money efficiently? We come right back here to the clean surplus return on equity. That's efficiency, folks. So, years to pay debt. Guess what? It's got no debt, and it has no dividend because it's taken all the money it makes and puts it back into itself. Folks, this is the way we like to look at a growth stock. A lot of people say, well, I want stocks that are paying 2% dividend, but they will not be full-scale growth stocks, because you want a real growth stock to take all the money it's making and putting it back into itself to grow. And it's part of the technical ETFs, that's the XLK. And folks, we like this stock very much. Yes, it's in our portfolio. It's been there for a long time. And let's look at the 1 year. Black line down here is the S&P 500, up about 18%, and this stock is up about 78%. This is over 1 year now. Again, the S&P 500 up about 18%, and this stock up 78%. So we're looking at almost a 4 times return than the average stock out there. And don't forget, over any 10-year rolling period, 96% of professional money managers who manage the publicly traded mutual funds, 96% of them over 10 years cannot outperform this black line down here. And our portfolios have done that over 22 years, 2.5 times on a compounded rate, return 2.5 times that of the S&P 500. So yeah, we're doing pretty good using this methodology, and you can see in the stock itself how it works very, very well on just about all the stocks we pick. Yeah, there are some in there that all of a sudden lose their luster, or they get competition from one of the biggies out there like an Amazon or something of the sort, and they don't work out. But that's why we have 30 stocks in our 30 stock growth portfolio. Now, over 5 years, well, the S&P down here returning about 97% over 5 years. That's pretty good, folks. 20% a year over 5 years. That's very, very good, because on average, over time, the S&P has returned about 10% a year, and that's what it's averaging over the past 22 years that we've been following it year to year and month to month over the past 22 years that we've been using this methodology. And okay, again, let's repeat, 97% for the S&P 500. And here's this stock, ARISTA, stock symbol ANET, up 1,087%. Folks, that stock is moving. But you got to look at this. Look at the volatility in here. Yeah, so these stocks are very, very good, but when they start climbing up like this, and boy, when they correct, they really correct, and it winds up usually being a very good buying opportunity. And since we hold our 30 stocks and hold the good stocks, we just held on to it, and boy, look at the nice reward that we got. We're at all new time highs as of yesterday. So folks, we had another record-setting week on the market. So go out this week and take your mind off the market. Take your pennies, spend some of them, and enjoy yourself, enjoy your family. Most of all, stay safe, and we'll see you right back here in a couple of days.